Alright, so welcome to lesson 8, developing a trading plan and resources to help you succeed. So if you treat trading as a business, then just like a business, you gotta have a business plan. You gotta have a trading plan. So a trading plan tells you exactly which strategies you are trading. Because there are so many strategies you could trade, right? So specifically, which are the ones that you are trading? And for each strategy, what's the setup you're looking for? What are the entry rules? What are the exit rules? What are the position sizing rules? What percentage do you risk per trade? How many trades do you take concurrently? When do you trade? When do you not trade? You gotta have a specific plan to give you that information. So only then will you get very consistent results. One of the reasons why most traders fail is because they do not follow any plan. So they buy when they feel like buying. Even though there's no clear setup, they'll buy because they say, I want to take a trade right now, or I'm feeling bored, I want to get into the market. All right, or I lost money the last round, I gotta make it back really fast. So they're driven not by a plan, not by a strategy, but by emotions. Okay, they sell when they feel like selling, or they sell when they are fearful. Right, they risk more when they're feeling confident. They risk less when they lose confidence. So as a result of doing that, they get very inconsistent results. Their trading doesn't lead to a positive statistical expectancy. So again, if you want to guarantee profits over a sample of trades, your system has to have a positive statistical expectancy. And in order for you to achieve that, you have to execute that plan without deviation. All right, so what does a trading plan look like? This is exactly what it looks like. And you can download it on our resource page, and you can, again, use this as a template to write down your specific plan. So this is how it begins, right? This is my trading business plan, which I use. So I write down your name, okay, and read the following statements, right? I'm committed to strictly follow my trading plan. And it's good that every day before you enter the markets, before you trade, you read your trading plan to kind of like frame your mind to follow this plan. So the following clearly defines my trading routine, so that every day I only look for trades based on this routine. Each trade outcome should be considered purely as a certain R multiple. And it's a sample of the larger statistical process of accumulating R multiples over time. So in other words, you think like a business, you think like a casino, when you think probability, right? On a microscopic level, in other words, on a trade by trade basis, each outcome is uncertain and random. Every time you put on a trade, you've got no idea will it be a winner or loser. Right? However, on a macroscopic level, over a large sample of trades based on a consistent routine that gives you a statistical edge, the aggregate outcome of many R multiples will be positive, because your average wins are more than your average loss, right? So the goal is to define a plan consisting of unambiguous entry, exit, and risk control criteria. In other words, your reason for entering must be a very objective reason that's predefined. So are your exit reasons. This plan gives an edge in the markets to you because of the following. Entry rules are sufficiently stringent to stay away from a lot of market noise and choppy behavior, and sufficiently capture price movements incidentally without the emphasis on predictions. Remember that as professional traders, we don't attempt to predict the market, that this trade will definitely go up, this will definitely go down. No, we've got no idea. We are playing the probability. Exit rules are defined to allow wins to more than cover losses in the long run, so that the win rate is no longer the emphasis. The position sizing method ensures that the risk per trade is a fixed percentage of the existing account balance, allowing the accumulation of R multiples to compound your account over time. Now, this is really important. Read this every single day. The edge provided by any trading plan must be preserved through psychologically conditioning ourselves to the necessary ups and downs that will happen in your account in the trading process. Undue concerns about short-term fluctuations tend to diminish or eliminate the edge that the plan is supposed to give. Because subtle shifts in our trading behavior, like taking profits too early, or shifting our stop loss, or entering when the rules are not clearly valid, leads to deviations from the plan, and that leads to a negative expectancy. All right. Right. So once you have, you read that every single day, you're clear on following the plan. Right? Next, list down which strategies you will trade. So if you're listening to this in level 1 of this course, you're learning one strategy, which is the main strategy which I use, which is the bounce strategy. Okay? If you're proceeding to level 2 of the course, you'll be learning a lot more other strategies, like the capitulation strategy, the Bollinger Mean Reversion, the impulse pullback, as well as day trading scalping strategies. So you're going to have a lot of strategies. Must you trade all the strategies to be successful? No, you don't have to. In fact, all you got to do is to focus on just 2 strategies. In fact, you can do well with 1 strategy, but 2 is really good enough, right? That you like, that follows your personality, okay? So list down specifically which strategies you will follow, and during days when trades come up, if it doesn't fit your strategy, don't take the trade because it doesn't fit your business plan, okay? Next, how many hours a day will you spend to find trade setups? You may want to list it down specifically. For example, every single day from 9 a.m. to 10 p.m., I'm going to look for setups and place my orders, right? Or from 2 p.m. to 4 p.m., for example. My suggestion is when you first get started, allocate at least 2 hours. Once you get familiar with reading the chart patterns, all you need is about 30 minutes to 45 minutes, right? Next, list down the entry rules. Now you've learned the entry rules for the bounce strategy. So I'll need to write it down, because when you write it down, you tend to take it more seriously, okay? Next, your exit rules. So again, there are a few choices, right? You can choose to, have an exit rule where it's a find and forget system. You enter the trade with a stop loss and target price and just let it hit either the stop loss or the target price, either getting 2.5 R win or minus 1 R loss, or shifting your stop loss to entry price when the price moves 1 R in your favor. You could do that, right? An optional approach would be, once you're in the trade, to constantly raise your stop loss the moment you have got an opposing candle. So if you're going long, you want to see bullish candles, right? The moment you see a bearish candle, shift your stop loss to a few cents below the low of the bearish candle. Again, this second approach takes a bit more work because you keep shifting stop losses, but the results are pretty much the same. The key is write it down in your plan which option you're going to follow and follow it consistently. Okay, next, what are your position sizing rules? I've mentioned in the lesson on position sizing that you gotta consistently risk the same percentage of your capital. So I suggest starting with 1%, and once you can get consistent results and you're confident, you can raise it to 2% and eventually 3%. So list it down and stick to that consistently, okay? Next, how many open positions are you allowed to risk at any one time? So a lot depends on your own personal risk tolerance, all right? My personal suggestion is not to risk more than 10% of your account at any one time. So if you're risking 1% per trade, you should have no more than 10 trades concurrently open at the same time. If you're risking 2% a trade, no more than 5 trades open at the same time. But again, if you like to put it to maybe 5% total risk, that's fine. So write it down. It's in your business plan. It's your plan. Follow your plan. Okay. Remember to print out this trading plan, fill it up, paste it somewhere, and read it every single day before you start your trading routine. So with that, let's move on next to trading routine.